Well, hello, folks. Welcome back to our Merit Moment, as we do every week. My name's JB Howard, and as promised, each of our weekly Merit Moments, it's going to come with a Howard Homestead update. So thinking back over the past week, we've been really pretty busy managing the kids' back-to-school schedules while running to and from wrestling and soccer matches. So the homestead this time of year hasn't necessarily been a primary concern. Still plenty of eggs, the pool's drained, and Krista's been running the wood splitter pretty aggressively based on my nightly reports. I was actually informed last night that she left the kids and I several large piles that we're going to be able to stack this weekend. So we'll break some hearts on Saturday morning, but they're always ready to help. So now today we're going to change gears a little bit and get onto our topic today. So we're going to dive into inflation today. I know it's not necessarily a super exciting topic, but I think it's incredibly necessary to understand inflation if you're going to create a retirement plan. So what is inflation? Simple stuff. Essentially, you can think of inflation as the increase in cost of an item over time. If you look up the website, usinflationcalculator.com, you'll be able to type in any date range you want to, start to finish, and find out how much inflation has affected the purchasing power of a dollar over time. An extreme example, if you purchase something for $1 in 1913, then in 2021, the same item would now cost $27.58. So as you can see, just in that short example, $1 doesn't get you as much as it used to. Prices just increase over time. And certainly we've all seen more than enough of that over the last 18 months, thanks to the pandemic. So this increase in price inside of an economy is called inflation. Imagine with me, if we could, that you own a business. In the business, you sell widgets. The widgets are selling out in stores across the country. So naturally, you decide to raise the price. Even with your new price, the widgets just keep selling. Would you see that as a benefit to your business? Certainly. If you use the increase in income to pay your employees more, they would see that price increase as a benefit as well. So there's definitely positives to inflation. And depending on who you are and quite frankly, how you're looking at it, we all got a little different perspective on that. However, there's clearly a negative factor to inflation. Eventually, the amount of money you're able to pay your employees probably won't keep up with the overall inflation rate. Generally, what happens in most economies is that your income stays the same, but the price of necessities increases over time. So keeping an eye on inflation is something our federal government takes pretty seriously, but they don't do a good job of controlling it. And we're certainly seeing that play out this year, especially when they start and continue printing money and keeping interest rates impossibly low. It's hard to get, to control those inflationary pressures. There's also a type of inflation known as demand pull inflation. If you know anyone in the construction industry, you've seen this part of inflation play out this year. This happens when the supply of something is down and the demand for that same thing is up. Vehicles, 2x4s, groceries, the list goes on, real estate, right? Steel and lumber, both seen a surge in demand this year, but the supply has been limited. The price of lumber shot up 200% in the summer due to a lumber shortage, as we've all seen. That's inflation, specifically demand pull inflation. High demand, low supply equals rising costs, and sometimes astronomical. So now that I've risked boring all of you with an economics lesson, let's get into some ideas for creating a retirement plan that isn't completely wrecked by what we now understand as inflation. First, you want to avoid long-term fixed income investments or instruments, things like long-term bonds. If they're set to mature in 15, 20, or 30 years, they're generally going to end up outpaced by inflation. We're setting ourselves up for a low rate of return over a long period of time. Those assets will be worth less as the maturity date comes. Second, research strategies, I should say, that provide you with a secure, guaranteed income in retirement. So you've got a base amount of income in order to build your budget. Maximizing Social Security, maximizing pensions, and adding in products with guaranteed payouts like fixed indexed annuities or FIAs. These are insurance products that help your savings outpace inflation, help your incomes outpace inflation. A fixed indexed annuity combines the benefits of tax deferral with the potential for interest earnings based on positive changes in an external index. We might be tied to the Dow Jones or the S&P 500 without having to put our money in the actual market. Pretty powerful. Because the market changes so drastically and the offerings change so often, we research these vehicles often. I know there's quite a few high quality options out there that can create peace of mind when it comes to creating a successful retirement plan. That's why I'm an independent advisor. I have the ability to find the best, brightest options for my clients, and I'm not stuck with any one carrier, any one company, or any one strategy. I found that each person has a unique plan and a special path to get there. Obviously, there's clearly ways to do this yourself. But if you get to a place where you feel overwhelmed, which is often what we hear in our office, this stuff is my passion. So apologies for that monologue. I get pretty focused finding solutions to really work and help our clients. We help more people, our company is more profitable. Anyway, we're talking about preparing for inflation. So let's circle back to that. Thirdly, let's be prepared to spend wisely. Many people downsize their homes in retirement so they have lower utility bills, lower property taxes, and possibly have no mortgage. Others consider that inflation can send the price of big ticket items like vehicles up quickly. For instance, over the course of last year, I just shared on social media an article earlier this week. The average price of a vehicle in the US 18 months ago was $34,000. It's now almost $42,000 for that same average vehicle. Okay, so those big ticket items can go up very quickly. So a lot of times people make the decision to secure those purchases before they're set on any kind of a retirement income. It's important to keep the realities of inflation in mind when creating your budget, building your plan. Finally, real key here is considering your standard of living. What is my income goal? Are there non-negotiables that you enjoy now that could be affected by inflation? What about healthcare costs? Have you considered how to save for eventual healthcare needs, whether it's traditional healthcare or quite possibly even the long-term care side of things? Do you have an idea of how inflation could affect the cost of healthcare as you journey through retirement? The fact is, healthcare is one of the areas that gets hit the hardest by inflation. It's just gone up at a rate clearly beyond traditional inflation. I know these aren't necessarily fun topics to discuss when we dream about our lives in retirement when we're done working, but they are realities that we've got to plan for. Highly recommend you reach out to your financial professional, a financial professional, as you dream about what you want your life to look like in retirement. Make sure you're including all these components. Inflation is the one we're talking about today, but taxation, longevity, sequence of return risk, market volatility. We look at trends every day and can help you calculate an estimate of how much savings you need to stay ahead of inflation. General rule of thumb has been to calculate an extra 3% each year in order to help you keep up with inflation. In other words, my income needs to go up 3% each year so my dollars have the same buying power. That said, over the last 12 months, inflation's been right at about 5%, highest it's been since 2008. Certainly, we're all hoping that it retracts. So the bottom line here is that there are ways to protect your savings so that you can get the life you want and avoid the pitfalls of inflation that inflation can cause. Now, I kept this short because I know I just threw out a lot of questions at you, a lot of data at you, and really questions that you'll need to take a moment to really consider so that your plan can be as successful as possible. So the promise is always, I'm here, we're here for you. You get stuck in the process, shoot us an email, give us a call, click on the website, do a complimentary 15-minute phone call. You're not alone in this planning. We want to provide that value. There are things that you just have to know in order to build a solid retirement plan. But if you get overwhelmed considering all those eventualities and all those considerations, you don't have to build it alone. It's what we do. So all in all, I hope you found education and focus today. Come back next week. We're going to be discussing the concerns and benefits of converting a traditional IRA to a Roth. Okay, so thanks for joining me. Enjoy the rest of your day. Thank you so much.